Welcome to The Explainer. Today, we're diving into Berkshire Hathaway, a true giant of the financial world, which is standing at a crossroads. Its legendary leader is finally stepping down, and pretty much everyone is asking the same question: what happens now? So here's the news that sent ripples through the entire business world. After more than 50 years in charge, Warren Buffett announced he's handing over the CEO reins. This is a moment people have been talking about, speculating about, for decades. And now, it's actually happening. And that, of course, leads to the trillion-dollar question. What happens to the sprawling empire that he built from the ground up? Can it possibly be the same company without him? It's a huge question for investors and really for the entire market. To even start to answer that, we really have to pop the hood and understand what this thing is. So let's take a look inside the incredible machine that is Berkshire Hathaway. Okay, so at its very heart, Berkshire isn't one single business. It's what's known as a conglomerate. And all that really means is it's a giant holding company that owns a whole bunch of different separate businesses that all pretty much run on their own. And this chart just shows you how diverse they really are. Take a look at the revenue from 2023. Manufacturing is the biggest slice of the pie, sure, but insurance and retail are right behind it. They are not reliant on any one thing. And that right there is the key to their incredible stability. And we're not talking about a bunch of obscure companies either. These are brands you absolutely know. I mean, Geico, Duracell, Dairy Queen. You probably see or use something owned by Berkshire almost every single day without even realizing it. But if you were to ask Warren Buffett himself what the real heart of the operation is, he'd point to one thing: insurance. He's called it the absolute core of the company, the engine that powers everything else. So why insurance? Well, it all comes down to this kind of magical concept called float. Think about it. You pay your insurance premiums, right? The insurance company gets to hold on to that cash, sometimes for years and years, before they have to pay out any claims. It's basically a massive interest-free loan from customers that they can then turn around and invest. And for Berkshire, this float is a gigantic, constantly refilling war chest. And that war chest, well, it leads us to one of the most jaw-dropping numbers in finance today. We're talking about Berkshire's famous, or maybe infamous, pile of cash. Get this. In the third quarter of 2025, that cash pile hit an all-time record, $381.7 billion, just sitting there in cash and short-term investments. That's not just a rainy day fund. It's an absolute fortress of capital. And to put that into perspective, you have to see this. Just a decade ago, in 2015, the cash hoard was under $40 billion. Now it's almost 10 times that. The sheer scale of that growth is it's staggering. So the obvious question is why? Why are they sitting on a mountain of cash? Why not buy more companies? The classic Buffett answer is simple. He's being patient. He's waiting for what he calls better bargains to show up. He's not going to overpay no matter how much cash he has. And what's crazy is that this discipline comes at a time when the company is absolutely crushing it. This isn't a business in decline. Just look at the revenue growth. It's more than doubled over the last decade. The machine is just spitting out cash at an unbelievable rate. But even a fortress as strong as Berkshire has to deal with the weather. And there are definitely some potential storms on the horizon. You can really break the risks down into two camps. In the short term, you've got things like an economic slowdown, which could really hurt their railroad and manufacturing businesses. But then you've got the big long-term stuff. Things like climate change, which could mean huge payouts for their insurance companies, or disruptive tech that could completely change industries they dominate, like auto insurance. And then there's this weird problem that's actually a result of their own success: their size. Buffett himself has talked about this. Because Berkshire is so massive, there are only a handful of companies in the entire world big enough to buy that would actually make a dent in their earnings. So all of this brings us right back to the central question, doesn't it? What does life after Buffett look like? Who's in charge? And can the special culture he created even survive without him? Well, we know who the next CEO will be: Greg Abel. He's a Berkshire lifer who's been running all of the company's vast non-insurance operations for years. We're talking railroads, utilities, manufacturing, the whole shebang. He's been groomed for this for a long time. But the biggest reason for optimism might not be a single person, but the culture itself. This is a company where the CEO famously makes just $100,000 a year. Why? Because management's wealth is tied up in company stock, right there with the shareholders. It's a culture of ownership and long-term thinking that's baked into the company's DNA. And so that leaves us with this final, fascinating paradox. For decades, Berkshire's greatest asset was its immense size. But now, as it enters this new era, you have to wonder if that very same size has become its single biggest challenge.